Alberto Amo, thank you very much for joining us on Trade Finance Talks TV.
Thank you for having me here.
So, a quick introduction and elevator pitch. Could you please tell us who you are, where you're from, and what you do?
Where I'm from Spain. I was a general relationship banker for corporates for many years. And then due to the changes of the industry, I became a manager of teams developing products and doing innovations. And because of the needs of the different products and the teams, I became someone with some depth in regulatory affairs for banking, and mainly on capital markets for different asset classes, which is what I'm doing now quite broadly.
Great. So, Alberto, can you give an overview of some of those asset classes you cover within global transaction banking at Banco Santander?
Okay, in global transaction banking, we are, in our activity in Santander, we're mainly doing ECA financing, structured trades. A big chunk of what we do is receivables and payables, so open account trade finance, and some of the regular trade business. Additionally, we take care of leasing, some kind of lending, and so on. And outside of GTB, I also work with other asset classes, always in the illiquid space and structures.
And illiquid space, very interesting in the context of trade and receivables finance. It's quite hard to, I guess, liquidate a bulk cargo shipment, for example. So why do financial institutions securitize and distribute risk within the trade finance space?
I think it depends on the relative position of the financial institutions. So at the end of the day, the raw material for any kind of banking activity, but also for trade finance, is capital, liquidity, and credit related to capital. So it would depend what your institution is looking for and the restrictions that they have, if they have restrictions with leverage ratio or with liquidity, whatever. For instance, in ECA, we play very much in cover bond kind of a space because we are looking for long-term liquidity and we are not restricted by any kind of leverage ratio. So we look for more return of equity versus return of assets, as most of the Americans do. And in short-term trade, we play more like credit relief. Capital relief is tricky for low-density assets like the short-term trade finance. It can be done, but you have to fine-tune very much the structure and the pricing that you pay for the coupon. So it depends on the relative position of the bank.
Yeah, absolutely. So trade finance is often touted as a relatively solid asset class. It's short term. It's self-liquidating, and you know, you're one of the founders of the ICC Trade Register, so you'll know more than anyone of its you know, incredibly low default rates. Is this making it more of an investable asset class from, say, pension funds and the like? And are you seeing these trends in the market?
We see the trend, but we still need a lot of education of the institutional investor side. It is not that trade finance, that at the end will be corporate risk or FI risk, is a better asset class per se. It's because the characteristic of being self-liquidating, short-term, and so on, we have early warning signals, and we can manage in advance our position. So when the default is occurring, we may be out. So it's not that the trade finance bankers are smarter. They have the chance to take measure and do management of the assets. And for the institutional investors, it's difficult to see the way you manage the assets and the servicing, and how you mitigate the risk because those early warning signals. So they need the right counterparty to be able to invest in the asset. Having said that, I think that there is an evolution in the last 4 or 5 years, and more insurance companies and pension funds, they are being interested and they are learning. Still not big amounts what they invest, but it's increasingly growing in this asset class.
Very, very interesting. And I guess related to that is the regulatory environment. I know you've done a lot of work on Basel III and CRD4 for trade finance. Can you give us a brief summary of some of the key findings and the impacts this has on access to finance, especially for small to medium-sized businesses?
I think that not many people know the small details that are embedded in the regulation when it comes to trade finance. So there was a time when we really had a threat that could be impacting trade finance, and there was a very nice work done, especially with the partnership with the World Trade Organization, Pascal Lamy, Mark, and different banks that we participated in that. So at the end, in CRD4, there is a number of features which are the one-year maturity floor, also in the liquidity coverage ratio and so on. But there was something very specific, which was the former definition of trade finance was really cross-border. We changed that, and domestic trade finance was also considered real trade finance. And that had a huge impact on the capital weight and the liquidity ratios of the financial institutions to be able to support SMEs. At the end of the day, SMEs, they are growing in the flows that they have with international markets, but they tend to be domestic at this stage. So they were not constrained as they could have done with these regulatory changes, and we kept growing this kind of domestic trade finance together with the cross-border trade finance.
That's interesting. So would you say if we perhaps removed domestic trade finance from these definitions, we might not see some of the restraints, the lending restraints we perhaps see today for smaller businesses?
Absolutely. I think that trade finance is trade finance. It's the same kind of transaction if you take some goods from here to Calais, to Madrid, or to Istanbul. You might face different counterparty risk, but the nature of the commercial transaction is really the same. So the way you weigh that and you manage the flows can make a difference. So now everything is together in the CRD4, and I think that made a difference. But not many people saw that slight turning point on the regulation.
But hey, the devil's in the details.
Absolutely.
To understand those nuances. So I guess taking a bit of a step back, what's your post-pandemic view in terms of prospects for stability and recovery in a bit of a post-pandemic world?
I think it's going to be a two-speed kind of recovery. We have been very selfish in Europe and the US in the way we provided the vaccination capabilities for emerging countries. We were involved in a number of propositions to, because it's very much in the nature of trade finance to look after the emerging markets and poor countries, how to finance building the local capabilities for the vaccination. Unfortunately, we didn't do a good job as an industry there. So now I think the recovery in Europe and Americas is going to be quite fast, but the supply chains are going to be impacted. So some of the local markets in Asia and Africa will take longer, and some of the suppliers will be necessarily affected locally and will be changed for other, maybe more expensive during some time. So there is going to be a dislocation of how we manage that kind of supply chains and how we finance. Hopefully, after some years, everything should be more stable. But now there is an important threat, especially in emerging markets.
Yeah, and I think that's really important, especially when you consider the interconnectedness of supply chains and also the complexity of global value chains, even between right now and the 2008 global financial crisis.
Absolutely, and when there has been a very important government measure to support, especially SMEs and so on. So when this measure are retired, I think there's going to be an impact on defaults. So it's a delay. I don't think it will be that as big as we thought at the beginning, but there will be a delay on how these defaults and some of the suppliers will fall down, and there will be a change in the selected suppliers for some of the companies. So more and more some of the big buyers or big multinational will be taking care of that supply chain not to fall, because it's impacting and delaying their operations. But again, I think during some time we had some bad news for emerging market, that we should take care of that somehow. So government measure, even multilateral, should be involved to try to keep those emerging market supply chains for a while.
Yeah, absolutely, and really important to consider that, especially in light of those conversations around the Basel III and the CRD4 trade finance regulations that kind of came into play shortly after the financial crisis in 2008. Alberto, thank you for outlining some of those really important details around trade finance regulation, the importance of trade finance as an asset class, and also how much the industry has moved and developed in the past decade or so. It's been great having you on Trade Finance Talks TV.
Thank you very much.